All right, up next, rising interest rates stifle corporate bond issuance in Nigeria. Now, this is the next conversation, and of course, Nigeria's corporate bond market has seen a sharp decline, dropping from 688 billion naira in 2022 to 141 billion naira in 2023. And of course, we are seeing further declines even in the first half of 2024. This downturn raises questions about the factors driving this trend, particularly the Central Bank of Nigeria's aggressive interest rate hikes, which have increased borrowing costs for companies. And of course, joining me for this, I have Oladipo Ajayi, Head, Fixed Income and Forex, Chapel Hill Denham. Thank you for joining me today.
Good morning. Thank you very much for having me on.
Well, I guess this is no news to you, and, it's obviously not a surprise. So, let me get your thoughts on it.
Well, it's not something surprising because I'm sure on this show I've mentioned sometime in January that any corporate institution that needs to actually raise funds needs to actually front run the market because it was pretty clear that we know that for a major part of last year, the MPC was not actually sitting, and as a result of that, we knew that it's going to be more an aggressive year, and as a result of that, we expect yield to actually go move upward, and so the impact of that is that it will be very expensive. So for some of the corporate organizations to actually come to the market and raise funds, and so also we saw the aggression of the DMO, most especially in the month of February when they were in the market offering 2.5 trillion in just one auction. Sometimes in February. So that's, if you look at that, some of those things already a precursor to tell the market that it's going to be a very tough year for corporate organizations actually raising funds. So I'm actually not surprised for what's actually happened because I know very well that it will be very difficult for corporates to actually be able to raise funds in Nigerian markets.
Well, how concerning is this trend, and what are the implications, whether it's for the businesses or even for the economy at large?
Well, at a point in time, the monetary policy guys need to make a decision. Should they actually follow growth or actually rein in inflation? And so when they actually decided to actually go after inflation, it simply means that growth will suffer. And that's exactly what actually played out. Because what it will mean is that will impact businesses. For some of the operators in the corporate space, and most especially the manufacturing companies. And if we check their financials, you will see that their cost of finance is now more elevated compared to what we've seen in the past. Because currently, if you look at even if the federal government coming to the market to actually raise a one-year paper, the effective yield is over 26%. So imagine a corporate actually coming to the market to come and raise a commercial paper, which is more like a short-dated instrument. You will understand what level of interest rate the market will require of such corporates. And don't also forget that the federal government instruments are not they are not subjected to withholding tax, and so but corporate organizations have to pay withholding tax, or you pay withholding tax on corporate instruments. So market will also need to factor that in. So it simply means that coming to the market, a lot of them will actually find it very difficult to actually raise funds, even around 28%. So
okay. Mr. Ajayi, I'm sorry to butt in here. We need to go on a short commercial break. When we come back, we'll continue from that thought. Thank you. You're still watching Business Edge, and of course, my guest, Oladipo Ajayi, is right here with me. Thank you for staying with me, Mr. Ajayi.
Yeah.
Right, before we went to that time out, we were talking about the implications and how this is affecting corporates. You might as well take it up from there.
So, like I was actually speaking, this actually increased the finance cost to some of these corporates. And when you look at their financials, most especially if you look at their half year, you will find out that the finance cost is now more elevated, and that will also impact the bottom line. And don't also forget that this will also be actually passed, most of these will be passed to final consumer, most especially if you're a manufacturing company. So it simply means that the price of their goods will actually inch up as a result of increase in cost of finance. So it is actually, it's been very, very turbulent for most of these corporates actually currently this year. And one of the reasons why I said January would have been a best time for them is that as of January, raising a one-year instrument for the federal government is around 8%. So it simply means that if most of these guys have actually they've been able to actually access the market around that time, they may have been able to actually raise funds maybe around 10% for more like a 270-day instrument, or they may actually be able to raise a bond, maybe like a 5 or a 10-year bond around that 15% at that particular point in time. But failure to actually take that short window, I think this is the current implication of such, and that's what we're currently seeing in the market.
Well, thank you for answering my next question, but I will still go ahead to ask you one or two things from that particular. I mean, I was thinking we would have to digress together, but we've seen a couple of, financial results in H1, and we cannot sort of ignore the rising costs. Now, whether it is cost of finance or operating cost, you've talked a lot about cost of finance. I'd like you to give us a sectoral analysis of the trend, maybe trying to tell us, the sectors that are most hit and all that.
Well, it's the sector most hit is they are actually manufacturing sectors because of the nature of their business. Most of them they need huge capital for operational activities, and they need funds to actually bring in raw material. And don't also forget that most of these manufacturing companies, they are heavily hit by FX loss. Both in full year last year and also as at the reporting Q1 for this year. So most of these companies are actually, they need huge liquidity to actually operate. And so it simply means that one way or the other, they need to borrow, whether to actually go to the market or actually go through the banks. One way or the other, they need to get a line so as to be able to access funds and be able to do that. And that's one of the reasons why you notice that the operating cost has actually gone up aggressively. And if you had actually dissect that operating cost, I think major part of it would have been the finance cost because of the cost of borrowing currently. I may bold to tell you that to actually be able to actually raise borrow funds from the bank currently, I'm sure anyone that's going to the bank will pay nothing less than about 33 to 34% to be able to actually raise a loan in the market. And so imagine you actually raising funds at 34% to actually operate a business. What level of margins do you need to make for you to actually cover your cost of funding and also be able to make a spread from such business? And that's one of the reasons why it's been very tough for business this financial year. But I feel that we are turning that level around now, considering the fact that inflation is already nosediving. So we expect inflation to continue to actually inch down in that stride. Although our view is that the 10-day strike in the month of August may have a negative impact on what we'll likely see in August. And coupled with the current fuel scarcity, that will also impact inflation figure. But when you look at it overall to the end of the year, we feel that inflation will actually drop, which will also necessitate the monetary policy guys to actually maybe soft pedal on the aggressive policy, which will actually reduce cost of funding to most of these corporates.
Well, you had to bring in the 10-day strike. I won't get on that right now. So let's talk about this. These companies, for how long can they continue on this trajectory?
Well, I think, like I said, it seems that the worst days are over because, like I said, if you look at the market, look at the rate yesterday, 1-year paper was raised at 20.9% discount rate by the DMO yesterday. And when
okay, Mr. Ajayi, I was speaking generally about operating costs, finance costs, and all of those things. I mean, the results, the H1 results we're seeing, and the trend it's taken and all of those. For how long can this continue? For how long can these companies, continue to report these losses?
So there are key things that we need to consider. One, stability of FX. That is very essential. And I think one of the decisions that the central bank made recently through the sale of FX via the outdoors window. It actually helped aggressively, where the central bank sold over $800 million to companies. And I think that's a plus one way or the other. It will help most of these companies to actually pay down on some of their obligations. And that one way or the other limit the level of FX losses that we should expect in their books. And also the stability of FX in the market will also be a great one for some of these companies. So they wouldn't need to actually book unnecessary FX loss. And at the same time, like I said, I expect interest rates to continue to go down now from where we are. When I mean interest rates, I'm not talking about MPR because we expect the MPC to maintain maybe till maybe early part of next year. But in terms of the cost of raising funds in the market, I think I expect rates to start dropping. And what that will mean is that it will actually reduce the finance cost of some of these companies. It also means that it will be easier for some of these companies to also come to the market to actually raise money in the capital market. And don't also forget that sometimes in August, we saw a circular by DMO where they decided to actually reduce the volume that was actually circularized to the market to be raised in the month of August. Initially, it was supposed to be 300 billion, but they actually released updated circular where it was reduced to 190 billion. And I think that would be more like the trend for the remainder part of the year. So what it would mean is that the remainder part of the year, you don't expect the federal government to continue to crowd the market. So it means that there will be opportunity for most of these corporates to actually come to the market and take advantage of the available window to be able to raise funds at a lower level than the current levels where they actually funding the obligation.
All right, already back to corporate bonds. Now, we all know something must give, and then given the desperation for hot money to revive the forex market, we've seen the CBN sacrificing the negative impact of elevated cost of capital on the profitability of corporates. Now, I'd like you to speak to us. Is there any policy that the federal government could wield, in the short term, just to alleviate the impact of all of this on corporates? We close on that.
Yeah, the federal government are already doing some things. When you are giving tax rebates and also import duty waiver on some of the raw material or imported stuff into the country is a way to actually help to actually stabilize most of the companies. So what it will mean is that the cost of production will actually reduce, and at the same time that will also improve their margins because most of them are finding very difficult to actually make a sizable margin, considering that of course the cost of production is already high, and to actually mark it up, it will be very difficult because when you look at what your competitors are doing globally, so it will be better for people to even import some of those products into the country, and it means that you will not be able to actually compete in that space. But when government now decides to actually give some of these companies more like import duty waiver, what it will mean to them is that it will reduce the cost of production and will also increase their margin. And by so doing, I think that will help them and give them more like a lifeline within the current tight economic space. And I think it's a very good one that the government has done that. Maybe another thing that the government also needs to do is that create a window where some of these companies can actually access fund at a lower than what they actually raising for with the commercial bank in months like a targeted developmental finance project where you actually target specific manufacturing sectors and actually pump money to more like at lower levels than where of course, if you can give them funds around 15%, 16%, or even 17%, some of these companies, they will actually rush at such opportunity, and that will also reduce the cost of production to them, and at the same time also help in actually reducing the current food inflation that we have been battling.
Mr. Ajayi, well, let me say Oladipo Ajayi, Head Fixed Income and Forex, Chapel Hill Denham. Thank you for your time and your thoughts on the show today.
You're welcome. Thank you very much for having me on.